Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our EIA show. Things got flipped because of Juneteenth, so we had this pushed back a bit. The same thing should happen not next week, but the week after when we have 4th of July. Typically that can move things around. You know, the holiday is technically, I think it's Tuesday, but as we get closer, we'll hone that in. So today we want to look at three key pieces, our normal breakdown. So for those that have been watching us, we've been saying that Brent is what we've been kind of basing ourselves off of, is range bound. 75, 76 is the target, but anything above that is going to if it goes to 73, 72, you're a buyer. If it goes to 77, 78, you're shorting, because that is really where things want to sit. And there's always going to be headlines, and my running joke was that they're playing spin the wheel again for the headline, because the headline came out saying that that Powell is talking about keeping rates elevated, hurting risk assets. It's like he said that yesterday, but yet crude went up $2.50. So the fact that now I think Brent came down 285, but it's at 74.27. Again, like it's just right where it's going to be, because again, this is where we're in this range, and based on the data, which is what we want to go through, there's nothing to break us out of that range at the moment. We do think that there is downside to that range, and we'll talk about that through not only just segment 1, but also 2 and 3, where we see continuous pressures on different levels of economic activity and consumer activity. So then that takes us to segment 2, where will summer demand take us? How has summer demand set up? Where do things look like they're going to be going forward? And I think that's going to be a key piece. Then we want to break down Chinese demand, because there's a lot of talk about Chinese demand and how that's going to save us. But when you start looking at the numbers, there's a lot of pressure to that view when you look at what China normally buys, how they normally buy, and why we think that's going to really kind of fall short, and how that relates to physical movements in not only the physical crude market, but also in the refined products world. So now when we turn to the data points, so when we look at total oil and product stocks, the surplus now from 34.7 to 28.3. But remember, this is looking at oil and products, and as you can see, it had that bounce with what we normally have in terms of those increases, and then things typically go sideways. Based on the data that we've seen from Fujairah, from Singapore, from Europe, from the US, there's really nothing to say that we're going to continue going up or really go down. It's going to continue to be that sideways move, especially when you start looking at total crude stocks, both land and floating. You can see here that we had that similar bump. The surplus widened from 24.9 to 28.9. Our concern here is that crude will remain a bit elevated on the floating front. And that's why we're going to see some of this really not have the same drop that people are expecting. And it's going to stay a little bit higher, which again is going to cap really where crude prices are going to go. But that floor is going to be OPEC. We don't have the supply that we should be having. And we're going to talk about quota versus production in segment 3. And that's really going to be the case, while product stockpiles, we think, just really marries along with where that the average is. So it flipped from a deficit from 9.8, from a surplus of 9.8 to a deficit of negative 0.6. So again, it's just, we're going to walk that line. And the reason why we're going to walk that line is because of that gasoline and gas oil, especially the gas oil side, where we were saying that there was a sizable drop, but we expected to see a big bump, which we did get, which we showed, and we'll talk about more in segment 3, because it is Thursday, so we were able to get the live data from both the Europe and Singapore, which is nice, which means that next week we don't have to talk about it because it'll just be the same. Now, total land storage, the deficit narrowed from 24.7 to 14.3. Land storage west of Suez, deficit narrowed from 12.9 to 1.4. East of Suez, which is just showing Japan, widened from 11.8 to 12.9. But when you factor in China, which we will in segment 3, you see that is actually closed much of that gap. And one of the things that we saw in the land storage side, which was what we were talking about, we didn't see the same type of following that trend, but we did see it going sideways. And as we were saying, as we got into July, end of June into July, you typically get those draws. We see that in terms of the comps getting easier, just running into that level, which again is going to cap upward trends. Like it's just going to be very difficult to see us break to the high side when you look at data like this. But again, there's nothing like it's like, oh, look at how big that storage is. We're here. This is the range that we're in. And let's be honest, OPEC wants 75. 75 is the target. You had Saudi do the extra million barrels. They'll likely have to do, and not do another, but just keep some of that offline. Now, will they maintain the full million from July into August? Probably not. Could they cut it from 1 million barrels to just 500 or 250? I think that is the more likely scenario, because if they cut 1 million and crude prices didn't move, so therefore they're losing money because they're selling less volume at the current price. So they're going to want to try to get some of that back, but they wanted to clear some of this floating storage, which again remains very high, which is why when you look at the data in general, this is where we have the most concern, because the surplus widened from 23.1 to 33.6. West of Suez, the deficit widened from 5.9 to 8.1. East of Suez, the surplus widened from 12.5 to 13.1. Now, the biggest issue remains, because when you look at West of Suez, Europe is meandering around normal. U.S. is on the lower side. West Africa has come down, but it's the Middle East that continues to be the issue, as well as Asia, which is why East of Suez remains that build point, and why we think we're going to get more of that floating storage, especially as Russia just dumps whatever they can into the market. Iran has been increasing their production, which we've been talking about, and we'll talk more about it in the last segment. Now, crude stockpiles had a draw of 3.83 million. The draw was driven by Pad 5. It had a draw of 3.53 million. Now, remember, Pad 5 is where you get a lot of that lumpiness in terms of what was the activity of the refiners. Was there a delay of some of those imports to bridge some of that, which then resulted in some of that excess crude getting pulled out? So again, everywhere else was fairly normal. Cushing had a small draw of 100,000 barrels. Pad 2, small draw of 810. Small builds in Pad 1, Pad 3. So again, things are fairly normal for this period of time. The question is going to be, how are the refiners going to operate given some of the extreme heat that's happening right now in Houston? Typically in this kind of heat, given what we also build things so that they can manage it, but you may not be able to run full tilt. You have to kind of manage to see, okay, well, where's the levels? You don't want to run things too hot, because obviously there's going to be more pressure. So those are some key things to watch going into the next few weeks. Now, when we look at crude oil inventories, excluding the SPR, again, you had some pretty stable numbers. As we've been saying, things we expected it just to go sideways. And as you can see, 2021, 2020, you have some of those, 2021 and 2019, you have some of those drop downs. You had it obviously in 2017 as well, but you were starting from a higher place. We just think that things go more sideways, where you're above where we were in 2022, but it's going to be similar to where we were last year, where things just go pretty much stable across, which is going to continue to be the case. Now, when we factor in the SPR, the draw was 5.55 million. Remember, there was those, we have some final sales as we get into July, because July triggers, the fiscal year for the U.S. government will be 2024. And if you remember, the sales from the SPR that were agreed upon between 2013 and then signed into law in 2015, have sales that end and expire at the end of 2023, and then they've canceled everything else from 24 and beyond. So again, that's where we're going to start seeing some of that money, some of that crude come back in. But again, these are things that we like to see so far. Then when we look at total U.S. commercial oil storage and products, pretty stable, again, something where we expect to go a bit more sideways and run right into where we were in 2021 and 2019. but it's a lot of that stability because we do see a lot of those imports remaining elevated for the gasoline side. We'll talk more about that in the next segment. So when we look at pad 3, we're coming right into this crux here, and this is what we've been looking at on the pad 3 fund is we expect this to continue to decline, but decline similar to 21, have that kind of stable move down, something similar that we saw in 2017, where we'll have draws from pad 3, but excuse me, but it won't be to the same level that it normally is or it has been in the past. Again, fairly stable in general. Look at Cushing. For those that have been following us, we expected the rate of change to be something similar to what we saw in 17. And then as we were saying, on a seasonality basis, we pretty much level off here. And typically we level off, we might have some draws. We just see this being fairly stable, especially as pad 2 imports remain a bit elevated and Canadian flows continue to support flows down into the US. When we look at runs came down slightly from 93.7 to 93.1. We had some increases in pad 5, which could have resulted in some of those shortages that we talked about. We'll look at imports in a minute. Then pad 3 had some unplanned downtime with 254,000 barrels a day coming off. Pad 2, a little bit of an increase as we had some work ending. But again, we're very comfortable in this 93% level. It's just as we go into July, we should trend from 93% now. This should be the low. Obviously, there can be unplanned downtime. 93% utilization should be the low, and we should now trend up to about 95% over the next few weeks. Obviously we'll have July 4th in the way, which typically they pretty much go sideways, but then that's when we're now in the heart of summer driving season and where we'll have the most activity from a refining perspective. And here's that in charts. You can see that there's typically that trend that continues through July. There's sometimes a dip in on July 4th. Sometimes it happens a little bit earlier. Sometimes it happens a little bit later. But again, the trend is still very much intact for summer norms. Now, when we look at imports, as you can see, imports into pad 5 dropped 241,000 barrels a day. Again, you had an increase in pad 5 refiners. You had a decrease in imports. Therefore, you had a draw. Pad 3 had a drop of 136,000 barrels a day, which again, it's going to be lumpy. Pad 5 is very lumpy. There's a certain amount of timing delays that always happen. And then crude imports dropped 220,000 barrels a day, which is still 904,000 below the 5-year average. But again, there's been that shift. The U.S. is obviously producing more. We're running more light sweet. A lot of the refiners starting really back in 2014 have looked at adding ways to run more light sweets, whether it's through alky units, whether it's through reformers, other processes that skip the coker, if you will, and go through a different route, because you do have to keep the coker, which is the pre-treatment for crude, heavier, just because you're cooking at a fairly high degrees, and if your crude starts too light, you burn off too much. So again, this is just some of those little nuances. I won't go too deep into it because I can get a bit nerdy about it, and then I don't want to lose people. So now when we look at crude oil imports, again, bouncing right along the bottom of that cloud, we do think that you get a little bit of an increase. Some of the new data from Nigeria has shown that the U.S. has increased some of those purchases. They're not here yet, but again, they're en route. So this will, again, support us coming a little bit higher, but still staying at the low end of that cloud, obviously below the 5-year average, and just staying kind of well within the center of where we are right now. Pad 2, as we've been saying, it's going to stay above the 5-year average. It's going to have some seasonal moves. A lot of the wildfire issues have now passed us. A lot of those pipelines are now turned back on, and that's going to keep things fairly stable coming into the U.S. U.S. imports, when you look at implied demand, finished gasoline increased 182,000 barrels a day. That's 9.19. That's 9.37 million barrels to the upside. Again, this is a little bit higher than what we were expecting. You did have the Juneteenth weekend, which means that you just had a longer weekend. Some people took this as an opportunity to go out and get an early start on the holiday week. A lot of schools ended the week before, so this was the first time that kids were off from school. My oldest wasn't off until this past Wednesday. So again, it's all a matter of where you are. But at this point, a large part of people are now off from school, kicking things up. As we've been saying, we think that 9.2, 9.4 is going to be kind of that level that we live in. We just think it's going to trend a bit down, a bit lower. Obviously, we're going to have that nice July 4th spike. And then the question is, do we get that spike in a bigger fade, or do we just hold that level of that July 4th? And we'll look at that on a chart in a minute. Distillate had a bounce of 404,000 barrels a day. That's typically, again, nothing moves up or down in a straight line. You're going to have some of that lumpiness. We still see that trending down. We had FedEx out again, cutting some of their expectations for not only just planes, but also from some ground as they see more slowdowns. Jet had the bounce. As we've been saying, you have to move some of those expectations up to about 1.5 to 1.6. Obviously, we had a bigger bounce to 1.8. But there was things were running much lower than we were expecting, so this is a bit of that makeup number. And then propylene had a nice bounce of 466,000 barrels a day, and that's something that's going to ebb and flow, but still trend a bit lower, just given the pressure in the petchem space. When you look at the gasoline implied demand, you can see that we're trending right just above the 10-year average, and obviously the 10-year average is skewed because of 2020. So I did an experiment, took out that 2020 average, and we're right at the 10-year average or 9-year average, taking out 2020. So again, we're still trending at the lower end of where we normally are at this point. At this point, we're typically closer to about 9.5, 9.6. And as we've been saying, it's just we're going to be 300, 400,000 below what is normal. And you can see that there's usually wider swings. Here we're a bit more stable because the orderings don't have to be, or the movements from storage or from the racks to the retail facing doesn't have to be extreme, because you're not getting these big drawdowns, these big rebuilds. Instead, people are moving about. They're increasing activity, but at a much slower pace, or at least a more measured pace than they have in the past. Days of supply, very normal, nothing really to report here. Gasoline storage, small builds, right now we're pretty close to where we were in 2022. We do see that creeping a bit higher because because of pricing in the US versus abroad, we're going to attract more and more imports as we come into pad 1, which again is going to keep us moving higher. Distillates, you can see here, we had a bit of a flatlining. Typically, the rate of change is paramount here, and it's going to be as refiners build back up and ramp up, that'll put more gasoline and distillate into storage. So here's some jet. Here's jet fuel that is, as we've been saying, they had some big builds. Now we had a nice draw. We'll talk about that more in the next segment. Now, when we look at the roll for the crude futures, here you can see that we're at the lower end. We're in some contango. But when you go back through the longer periods, you can see that things are getting a little bit stronger than they were 2 weeks ago, but nothing too crazy one way or the other. This still supports activity, especially when you start looking at the spreads. And we're going to talk more about the spreads between sweet and sour, medium and light in the segment 3, because we are seeing some price differentials between the two. Now, when we start looking at crude in floating storage, you can see it's fairly stable. We do see this edging a bit higher, and it's all going to be a matter of when do those Nigerian barrels show up, and how quickly do we import it into the US, which is going to create a little bit of that lumpiness. But we're right where we were in 22, 21. We don't see this big increase. If anything, more of that standard kind of sideways move. So that's what we have for you on the global side, and just giving you an idea. There's nothing really hugely bearish. There's really nothing hugely bullish. It's just kind of normal at this point. Some things are trending below normal, some things trending right at normal. So again, that's why we're confident, and we've been confident in this range-bound situation. We do think that starts to break down as we get into August, as you look into September, and that's where we see some of that downward momentum. But again, we're not OPEC is looking at supply very closely. This isn't like, oh, we're going to go from 74 Brent to 54 Brent. No, it's, maybe we go from 74 to 68, on the downside, maybe 67. And it's because of that supply side. And that's why, we think that we're fairly range bound. There is some downside risk, but not yet, especially going into peak demand. July is going to keep us elevated, but as that demand diminishes just along seasonal lines, that'll pull down some of that crude pricing, which is why we see some downward pressure as we go into August and September. So that's what we have for you here. In the next segment, we're going to go deeper into the U.S. and U.S. demand.